All right, welcome to this breakdown of C Limited Q3 earnings. I've previously been doing some videos on a YouTube channel, and I'll probably come back with more English spoken content. The program for today is we're going to do a short status on NewDeal Invest, which is the investment fund I'm representing. And then we're going to do a short intro to C Limited, and then we'll do a digestion of the Q3 earnings of 2023. The charts on the picture here is Microsoft and Apple charts coming from 2001 to 2013. So what you see is that Microsoft performed poorly in that period, delivering no or negative returns, and Apple grew from being a fraction of the market cap of Microsoft to being the larger company of the two. That's really interesting, and you all know that this is due to Microsoft not winning the mobile telephone era, and Apple winning that. And actually, it's the internet era that that Apple won, and the internet went wireless, and the smartphone became the dominant online access device. And what I think is interesting and is sort of a core value for NewDeal Invest, a way to look at the world, is that this interview is represented in this interview. It's the year is 2007. We're a couple of months before the launch of the iPhone. Steve Jobs has the iPhone 1 in his pocket. And Microsoft, represented by Bill Gates, is the larger of the two companies by far, the winner of the PC era. And this is at the D5 conference, and they are being asked about the future of the future of digital devices, edge devices, and stuff like that. And every time there is a question, Bill Gates has confidence, and he answers, and he gives his view on where the world will be in 5 years, and he seems quite certain. And when we look at it now, we know that he was dead wrong on many of the assumptions he had. And Steve Jobs, on the other hand, was more like, I don't really know. It's hard to tell. And it was very clear that he had the nimble mindset. He was respectful that the future is so hard to predict. And he actually one time said, I think it feels dangerous right now. It feels like the world is changing right now, and what was about to change the world was the launch of the smartphone, and we were about to have 4G 4G telephones coming out a few years later, really accelerating what we could do on a wireless device. And so he was dead on with it, and he was very humble and accepting the fact that he couldn't tell the future. And that's really what we want to build on in NewDeal Invest. Our first principle is just to build a broad tech portfolio without dead weight. So you have a lot of people out there seeming to know which companies are going to be the winners, and they're probably somewhat like Bill Gates back in 2007. And we want to take the opposite approach. We want to accept that we don't know which way tech is really going, and it feels dangerous. We have AI coming out right now, so a lot of things is going to change. Value chains are going to change. So what we want to build is a broad tech portfolio without dead weight. A lot of people think it's common knowledge that tech was dead in the zeros, but actually tech wasn't dead, but Nasdaq was dead. And Nasdaq was held down by dead weight from the big companies of the PC era. So this chart here shows the large companies in the NASDAQ in 2002. They're the red lines. And the blue lines are the large companies in NASDAQ in 2022. And we see that the blue companies are growing a lot during the zeros. They're just too small to move the index. So if you had an index that didn't have the dead weight, that would have been very, very successful in the zeros. And in some ways, I think we have a similar future at the point we're in right now. About the timing for tech investing, I just want to show this chart here, which is from TDM Growth Partners, an Australian growth investing company. And they did an index of growth companies back around the great financial crisis. It's a green index here. And what you see is that their index outperformed thoroughly during this period. You also see that this green index underperformed thoroughly during the great financial crisis, at least during the first parts of the great financial crisis, where it crashed harder and faster than the rest of the markets. But then from that point on, from the early point on, it outperformed again thoroughly compared to NASDAQ and SP 500. And I think there are a lot of similarities now. We've seen tech really melt down and fall hard and furious and fast. And I think this really speaks for why you should be in tech and growth companies at this point in the meltdown we have now. It's the same thing if you go back to the .com and take a look at that. So the NewDeal Invest fund, we have our main fund, which consists of 4 portfolios. We have a broad tech portfolio consisting of the second largest tech companies in the world. And it looks somewhat like an ETF, but without the dead weight. And it's up 41% this year so far. Then we have a value tech, which is the more mature tech companies that are typically with more positive bottom lines. We have some of the big tech companies in here that we find are still leading edge technology companies, and it's up at 58%. And that's really tells a lot about this year that big tech has outperformed. Then we have a blockchain portfolio, only public listed companies, but giving a high exposure to the blockchain technology as a whole. And then we have the alpha tech portfolio, which is up 50% this year, which is based on gorilla tech, but we are more concentrated in the positions that we believe the most, and Nasdaq is up about 35% this year. So that's NewDeal Invest, and we have a UCITS fund, which is a public listed fund in Denmark. The ticker is NDI PMI, which is just one portfolio with a combination of all of these. So it's just one broad exposure to digitization of the world, an ETF towards digitization of the world without the dead weight. So over to the topic of today, which is C Limited. And I just wanted to briefly talk about what C Limited is. So we have 3 companies. That's a typical way to look at C Limited. I think you need to I'll show you later that that's probably not the best way to look at C Limited. But we have Garena, the original company, which is a gaming company. It is the dominant games publisher in Southeast Asia. And that is their long-term thesis. They are a games publishing company in Southeast Asia. They publish for Tencent and for Activision Blizzard. They have Call of Duty Mobile in Southeast Asia and in LATAM as well, at least for the Tencent games in LATAM. And Garena's core competency is that they are very good at making games function well on the lower end smartphones, which is the predominant smartphone of the consumer in Southeast Asia and Latin America. And then they also built games themselves, and they had a massive success building a game called Free Fire, which is a first-person shooter game, multiplayer game. And it was one of the biggest games in the world for a couple of years, and actually the most downloaded game worldwide in Q3 this year, accelerating a little bit again. The way a mobile game usually performs is that it spikes if it's a success, and then it wanes off. And once it wanes off, it's extremely difficult to reaccelerate it. So that should be every investor's base case, that Free Fire will not be a permanent success and will probably wane off eventually. Yeah. So, but the game publishing part is just ongoing and is a good business, and is not depending on any specific game. But Free Fire just became the major part of the Garena thesis, and I think that confused a lot of investors. Then we have Shopee, which is their e-commerce platform, and you need to realize there are three components of Shopee. We have the logistics, we have the 1P, where Shopee is just buying stuff and selling it to customers. It's low margin and it's not very attractive and it's not growing. And then we have the 3P business, which is sort of the core business they want to grow, where they are just a platform facilitating that sellers can open a digital store and sell to customers on the Shopee platform. So this is the interesting part. And then we have C-Money, which is their fintech ecosystem. I'll get back to that. So if we just look at the history, in Q2 2021, Garena was about half of revenue, and Shopee was about half of revenue here. Then a year later, Garena had shrunk, and that's Free Fire revenue that is shrinking a lot. And we see that C-Money is actually growing a lot, and Shopee is growing as well. And in Q2 2023, we see that Garena has shrunk further. The shrinking here from here to here is not that big, but we have the other parts here growing, the C-Money and the Shopee revenue is growing. So yeah. So that's an important context. But I have some better pies, which are actually better. I'll get back to that later. If you look at the Garena revenue, it's really important to understand what happens when you go when you do GAAP reporting on a gaming company. So we have bookings, which is when a player deposits money on Free Fire, then it becomes bookings. So it's money that C Limited has right away, but it's not recognized as revenue in GAAP earnings in total upfront. It's recognized in portions. So you get something called deferred revenues, which is a part of the bookings that's not being recognized immediately, but later on. And then you could also look at the EBITDA, and when Garena or C Limited reports adjusted EBITDA for Garena, then it's based on the bookings, and that's really important to understand, and that's why I like the adjusted EBITDA for Garena best as metric. So I use bookings and EBITDA. And here on the chart, you can see that bookings, the blue, starts falling from Q3 to Q4 and then declines here. But actually revenue, because of deferred revenues, actually keeps increasing a quarter more before it starts to decline. Then there are some abnormalities here. So revenue is not really a good metric for, is a really bad metric for Garena to look at. And that means that every time you look at GAAP earnings for the total company, it gets a little bit meaningless because of Garena revenue being part of that equation. So here is just where you can see it in the earnings. So I took this from the Q1 2022 just to illustrate my point. Here you have digital entertainment, and you have operating income of 657 million in 2022, and the adjusted EBITDA is somewhat lower, and the reason for that is deferred revenue here. And if you go back to 2021 Q1, you actually have that the operating income is lower than the adjusted EBITDA, and that's because of the deferred revenue being deducted at that point in time from the total revenues. So it just changed, and that's why EBITDA and operating income will be different in Garena. So use EBITDA and use bookings when looking at gaming companies. So the investment thesis for the company, for Sea Limited, is that it's going to be the Amazon in Southeast Asia. And Southeast Asia is attractive in itself. It's got a young population. It's got a low digital penetration. So the digital economy is going to grow for many years, and the economy is going to grow because of their distribution of ages in the population. So very attractive area, digital in Southeast Asia. And actually where Amazon is building a platform based on logistics and scale, Sea Limited is building a super app, because they also have the Sea Money part in it, the digital financial services part of it, and they also have the dominating games company. So they got games, they got e-commerce, they got Sea Money, and in Q3 this year was the first time that Sea Management really described Sea Money, and I was a little bit thrilled that their buy now pay later platform seems to be very big. They have $1.4 billion in buy now pay later loans. And buy now pay later is very attractive to merchants and buyers. We saw Block, former known as Square, buy Afterpay, the Australian buy now pay later company, because they talked about how Afterpay is or buy now pay later is really attractive both to merchants and buyers. It's increasing the merchants' sales, and buyers like it because they get access to credit. Young people today don't have credit cards; they predominantly have debit cards. So this is attractive, and buy now pay later platforms are also marketing platforms. So it's a big deal for the ecosystem. And then they also have a logistics platform, which is growing. And logistics was more up in this Q3 earnings than it's been before. And they talked about how they were able to lower prices on logistics. I've shown it here. The green column here is value-added services, which is mainly logistics, and you see logistics revenue actually falling over the last 3 quarters, even though GMV is growing and or revenue is growing, GMV is growing as well. Then we have logistics revenue falling. And that is their logistics platform gaining scale and being able to lower prices. Yeah, but let's look at Shopee revenue, the e-commerce platform, because it's a thing that confuses people as well. So we have the blue column here, that is total revenue that we have here. So total revenue consists of marketplace revenue, which is the red column, and then product revenue, which is the 1P business. And so it's, and 1P business is not attractive, so it's better to look at the marketplace revenue here. So the marketplace revenue consists of the yellow column called core marketplace revenue. That is the fees that Shopee are getting from sellers, and it's the ads business. So it's a SaaS business with an ads business on it. And then, so that's the one part of the marketplace revenue. It's a core marketplace revenue. And then we have the green column here, which is the value-added services, and that was logistics. So when we look at Shopee total revenue or marketplace revenue, we actually have a component, which is logistics, that's falling in revenues, and that is really a good thing. You know, my son has a 3P logistics company that helps small e-commerce companies get good deals and do their 3P logistics for them. And he also does some customer service and helps them with other things, procurement, and sellers are really price sensitive when it comes to logistics. So when C Limited has a logistics platform that's able to lower their revenue despite increasing volumes, that means that prices are falling a lot, and that's really a huge tailwind for the ecosystem. So back in the days, Shopee, when they did marketing, they would do it by giving vouchers on free shipping. So you would see this part of their revenue actually shrinking when they were marketing. That's different than when they are using paid marketing, because then it'll be lower in their earnings. So then it'll be below the gross profit. But this logistics costs are in the revenue and in the gross profit, affecting it in two ways. So really, total revenues and marketplace revenues, they're not good if you want to evaluate whether sellers are increasing their businesses on the Shopee platform because of product revenue and value-added services being a part of it. So you need to look at the core marketplace revenue, the yellow line here. And that was growing plus 30% this year. So that was nice, but logistics was falling and product revenue was flat. So then let's look at this core marketplace revenue and try to figure out what does that look like as a business. And here, this is from the latest earnings report. We see that we have e-commerce and other services in the revenue line. That would be digital financial services is in this bucket as well. And we see here that the revenue is up 23%, and included here is the falling value-added services and the flat product revenue as well. And we see that growing 440 million here. And then we see the expenses for e-commerce and other services, and they're actually flat year over year. So we see their gross profit expanding from this figure here minus this figure here, which is about 570 million, to this figure here minus this figure here, which is a little less than, which is about a billion. So we see their gross profit almost doubling in Shopee. over the last year. Yeah. So that's nice. And then let's say value-added services, which is a part of this number here, operates at 10% gross profit, and then Shopee gross profit will be about 55%, or Shopee core marketplace gross profit will be about 55%. So it's a high margin business, and that makes sense because it's software and it's advertising, so it makes sense. But it's important to understand which buckets are growing, and that it's the attractive, high margin, high operating leverage parts that are growing. Then we had a number that's shot up this year, and that's marketing expenses. So we have them here: sales and marketing expensive. Last Q3 it was 816 million. This Q3 it was 980 million. But this number, 918 million, is about the same as in the preceding 2 quarters in the first half year of 2023. So they actually doubled their marketing expenses this quarter compared to last quarter. And that naturally, that's the reason that they went from being net positive to net negative. But this here is an investment. And when do a super app increase marketing spend? So before 2022, competition was fierce due to low capital costs. That was the sort of, that's also been the pre-COVID environment, but also the COVID environment. And that meant that digital platforms would invest with poor or negative ROI just to keep their market position, not to lose market share. That was kind of a prisoner's dilemma, that there was too much money. Is that the same now? It's definitely not. Now, post 2022, capital has increased in cost a lot. So we don't have this fierce competition anymore. So now we invest with good ROI, and we invest opportunistically. And my take is that C Limited sees gross profit on incremental revenue in Shopee is 50% or more. And they probably see their investment spend is earned back in less than 3 quarters. A couple of years ago, they said on one earnings call that they were earning back their marketing spend in 3 months. And they haven't said anything about it in this environment. So let's just assume that it's 3 quarters. And then investment is a no-brainer. You get your money back in 3 quarters. Then you have more scale. You have you inject, you make the flywheel spin faster. You get more buyers. That means you get more sellers. When you have more sellers, you get more selection. Then you get more buyers, and then you just keep marketing to get that flywheel rolling. So investing is a no-brainer for them. They shouldn't be profitable. If they are profitable, I would be concerned, because that would mean that they could not see a good return on investment on marketing. So I want them to be negative, and I want them to have high marketing spend, because that is a sign that they see profits on acquiring new users, and that's what we want to see. So the market and the analysts just keep asking for profitability. That's really dumb, because that's not what you want this company to be. You want them to go loan money from their aunts and uncles and whoever has, because they have such a good way of investing that in new users. That's what you want to see. So you want to see them be as negative on the bottom line as they possibly dare. So let's go to try to value C Limited. Which part of C Limited do we like as investors, and which part are the attractive businesses? So we have 5 businesses here. We have the gaming business, and gaming I don't like it as a business. It's hard to predict. You might get a really good game, and then it's heydays, but you might also not hit anything, and then it's not so good. I think what you should think about is, why did Microsoft buy Activision Blizzard? And my take on that is that today, with the regulation of data, it's really hard to get access to people in a way where you can target them precisely. So you have to own the asset to be able to do cross marketing, to construct the business in such a way that you can do cross marketing. And I'm sure that Sea Limited has that figured out, so that they can do cross marketing from their gaming assets. All the users playing, they can get them into the ecosystem. They can give them perks if they install and pay from a wallet on Sea Limited. You can give them discounts on the Shopee platform, and vice versa. So they have 3 platforms cooperating, and gaming is a very important part of that, because they get the young customers. They get access to the young customers. Then you have logistics, and so gaming is a neutral here. It's black. Then you have logistics, and logistic firms are not nice. But I really like Amazon because of their logistics business. It's a moat, and therefore I like Sea Limited Logistics. But it's not the revenue line that I want to see grow in Sea Limited earnings, because it's kind of low value. Then we have 1P e-commerce, and 1P e-commerce is just a lot of working capital and low margins. So it's not really something you want to see grow. And Sea Limited hasn't grown their 1P business for years now, and it's more supplementing the marketplace. They ensure that a buyer can find all the products he need, so he doesn't have to go to another platform. So they do the business that local merchants don't want to do to complete the marketplace. Then we have the attractive parts of Sea Limited, the 3P e-commerce. That's just a great business. It's low capex, it's high scalability. You generate lots of data. Data is a strategic asset for businesses nowadays, and it's due to regulatory scrutiny. It's not something that you can just go out and buy. So being a business that generates being the business that generates by far the most data on the Southeast Asian e-commerce market is just amazing, an amazing asset. Then you have fintech, and I like fintech. Also, they create a lot of data. It's the point of sale, and that's where you can that's where you're allowed to keep the sort of data, generate data, and then they're generating a lot of cash. They have float, and yeah, it's just a good business. I'm worried that standalone fintech could get commoditized somewhat in the future, but fintech built into e-commerce platforms, I think that's just a wonderful business. Mercado Libre is doing it, Shopify is doing it. Yeah. So let's have this angle on, and then look at the development of the revenue distribution of Sea Limited. So the blue part of the pie here is the 1P business, and it's about 300 million. And you actually see that it's fairly constant in size, and that means that the overall pie is not really changing that much from Q3 2021 to Q3 2023. But what you see changing a lot is the distribution between the non-attractive parts of Sea Limited and the attractive and high growth parts of Sea Limited. So back in 2021, the orange and the green here, that was fintech and core marketplace revenue, representing just a little bit more than a fourth of the revenues. In Q3 2022, we're up to more than a third of the revenue. And in Q3 2023, we're up to more than half of the revenue for the fast-growing, high gross margins parts of Sea Limited. So I've advocated for quite a long time that when you are valuing Sea Limited, if you find it hard to do, then just try to say that Sea Limited's value is the green and the orange part. Just disregard the rest when you're doing valuation. Take them out of the numbers, and that would be easier to get a good value of that. So let's try to do a sum of the parts analysis. So gaming, Garena, they do 1 billion a year in EBITDA, and gaming companies are 12 EV/EBITDA of 12 billion of 12 is a common ratio to think about a gaming company. And I think I talked about Sea Limited or Southeast Asia being a young population, growing population. And a developing economy. So I think the dominant gaming company in that region is quite attractive. So I think 12 billion in value is quite fair. The logistics revenue, 2.2 billion. I just put a 2 billion number on that. I don't know. And then the 1P e-commerce, 1.2 billion revenue run rate yearly. I just put a 1 billion value on it. You could just treat them as a zero if you want to. And then we need to look at the 3P e-commerce business, revenue run rate of 5.2 billion, and the fintech business revenue run rate of 1.8 billion. What are their values? Let's look at the e-commerce business. We have a growth of 32% in dollars. It will be somewhat more in FX neutral. They have a gross margin above 55%, as I looked at before. And then the important part for the long-term investor is, how do you see Shopee? And I tried to put it here. Shopee is dominating in their markets. Flywheel is leaning towards them. They have a dominant logistics business that is able to cut costs and actually operate for zero margins. That is a superpower for an e-commerce business. Then they have a dominating fintech business as an ally. They can cross-sell, they can do discounts, they can do opportunistic discounting, whatever, to acquire users. That is a superpower for an e-commerce business as well. Then they have the dominant gaming company in the region, like Microsoft, that they can share data with and cooperate with. That is superpower number 3. And then they have this gaming company that, besides being a superpower, also injects $1 billion a year in cash. That's quite nice as well. And then you have the geographical location. Sea Limited is leading in the 2 most attractive geographical regions in the world. LATAM only in Brazil, and then in Southeast Asia. So I think some people would say that India is the most attractive right now, and I think it probably is for business, but I don't think India is very investor friendly. So I think Southeast Asia and LATAM are the best regions, and probably Southeast Asia as the region that strikes you as the most stable. Then let's try to put a price tag on this software as a service business with the revenue of 5.2 billion, growing 32%. If we do EV sales of 5, then it's 25 billion. And if we do EV sales of 10, then it's 50 billion. And you can just figure out what you want to put on it. Yeah. Then we have fintech. Fintech is it's the leading fintech platform in Southeast Asia. It's cooperating with the leading game publisher and one of the largest mobile games in the world. That's a superpower. They are cooperating with the region's most dominant e-commerce platform. That's a superpower. They are profitable and growing 37% in dollars and more in constant currency. Yeah. So if you want to put an EV sales of 5 on that business, then it's 10 billion. If you want to do EV sales of 10, then it's 20 billion worth. So if you do the soft, and I just do the conservative scenarios here, then you get 50 billion in total. Current market cap is at 21 billion at a share price of $37.6. If you look at the revenue distribution, you now have 35 billion in annualized revenue, growing 35%, and you have 15 billion growing 5 to 10%. So just from this here, from this larger distribution of the high growth parts of the company, you'll get a naturally accelerating growth. So I think there are two upsides to the growth. There are some upsides to, I think there is an upside to the growth estimates. You have the cloud business. C Limited is investing in cloud business. They're going to try to do the same they're going to do an Amazon Web Services for Southeast Asia. Then they're going to be distributing AI in Southeast Asia, much like Amazon is going to distribute AI to their merchants via their Bedrock and via their Bedrock platform. And then you have the fact that it's underdeveloped markets, and then you have the ads business, which is going to generate a lot of cash going forward. So fair value, you go figure it out yourself. But in my opinion, this is a very conservative estimate, and it's actually more than 100% above the current value of the company. So what happened at the earnings? I think the lazy perception of C Limited is what confuses people, because if you splash it all together and you use GAAP revenue, then you got a business growing 4% and is loss-making, annualized revenue of 13 billion, and then it's priced at 20 billion. That seems quite fair, to be honest. But you have to do the above digging to really understand what the business is worth. And then the large question that everybody's talking about is that, is Chinese e-commerce a threat? And management actually has been answering this question for several quarters now. And here is a recap of what they said this quarter. On this quarter, Forrest Lee actually showed that he's learned speaking English. He was participating a lot more also in the Q&A session. So I guess maybe he's been using Duolingo or something like that to get to know English. But here, I think it's their CFO probably speaking here. He says, I think number one reason, the question is what their competitive advantage is. And they are a clear market leader. They have scale, and that's so important. They have better data. They have better cost efficiencies. They have a denser network, and that all leads to cost efficiencies. Then you have their number two is that they are leaders locally, and they have a history in all of these geographic regions. They have headquarters, they have understanding of the local markets, and that's actually hard for a newcomer to do that. And then the third here is that, and I think that's the most important, they've built e-commerce infrastructure. That's not just logistics, but that's also software, and it's customer service, it's trust that they've built over many years. And it's not something that you can do in 1 year. No matter how many money you plow into it, you can't build it. You cannot just hire tens of thousands of people across Southeast Asia and build an organization that works just at one. It takes years to build. So C Limited is not just ahead in their market share, but they're also ahead in time, in time for building the organization that it takes to do this thing that they are doing. And I think that's overlooked by the markets. Market think that if you just plow enough money in, you can just build it, and that is so wrong. So yeah, that was my my C Limited thesis. You can subscribe to the NewDeal Invest YouTube channel. You can also subscribe to our newsletter for similar content and about our portfolio. I will be doing more English spoken content. We have investors that are coming from outside Denmark, so as a service to them, and also for all our followers abroad. So stay tuned for more, and hope you enjoyed this breakdown of C Limited. Thanks for listening.